Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mark-eitel.
Yo, Adrian, cut me Mickey. Hey guys, every time I hear that intro, I just charge up the steps of the museum in Philly, and I feel like I'm Rocky. That's such a great intro. But anyway, guys, my name is Mark-eitel, and you are tuned into the Mr. Mortgage Show. And guys, we have an awesome show lined up for you this week. Man, oh man, a lot of data was released this week. A lot of confusion. Is it good? Is it bad? What's happening in the housing market? Where are interest rates going? Some people are saying rates are going to 8, and other people are saying rates are going to 4. And are they going to meet in the middle? Where are they going to land? Guys, we're going to dive into all of that. We're going to dissect the data. We are going to get to your questions and comments. That is always my favorite part of the show. If you've got questions or comments, just give us a call or shoot us a text. That number is 855-462-7292. That's 855-462-7292. That is affectionately known as the Anytime Hotline. It rings right here in the studio when we're on the air, but it pushes to my office when we're not. So 855-462-7292. You can call or text that number. And Jen, my producer, is womaning the Anytime Hotline, and she'll get you on the air. If you prefer to shoot us an email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can send your questions over to us that way, and she'll read them on the air for you. As I mentioned, a lot of confusion, a lot of anticipation. CPI numbers were released on Wednesday. What does the 4.9% inflation index mean for interest rates and mean for housing? Guys, we have some residual leftover questions regarding the quarter-point rate hike last week. Who's Robin Hooding my rate with those LLPAs? We're getting a ton of questions about that too, right? We had a long, lengthy conversation about it on the air with loan level pricing adjustments and what that means to interest rates. So guys, all of this is kind of filtering through the market, and there's a lot of confusion about it. So I just want to share this, guys. The CPI number on the surface was a good one, right? It was less than expected, but still up, because we're talking year over year. And last year, inflation was scorching, and we're still nearly 5% over this time period last year. So still high inflation. But the smart people are saying that we're trending in the right direction. But if you look at that chart, man, oh man, the daily expenses are still whacking us right in the face. Eggs, I just don't understand the whole egg thing. But anyway, we did that show on whether it makes sense to build a coop or buy the eggs, and I weaved it into a real estate analogy. But I look at the CPI index chart, and guys, I posted that to the Facebook page. And you can find that by visiting mrmortgageradio.com and clicking on that Facebook link. Things like bacon and fuel, yeah, they're down, but rent's up. Getting your car serviced is up. Yeah, airfare is down and rental cars are down, but who can afford to go on vacation with what's going on in the economy right now? So it's kind of bittersweet, because when you look at the categories that are most affected by inflation, a lot of it is the stuff that we pay for every day. So it still feels like we're really, really in a bind out there. And I know all of that has people confused, because on one hand, they're hearing positive inflation numbers, and on the other hand, their checkbook is just not seeing the results of that. So I think looking at the CPI numbers when it comes to making a decision whether it's the right time to buy real estate is the wrong thing to look at. I don't think the CPI number matters. I don't think interest rates matter. I think there are many, many more important things. And we gave away a t-shirt to the guy who knew the answer to what is the most important number in a real estate purchase transaction last week. And if you missed that, guys, go to mrmortgageradio.com and click on that podcast link, because each week after the show airs, Jen takes a recorded version and posts it up on the internet as a podcast episode. And we got a ton of great response. There was a lot of good Q&A last week, a lot of good back and forth. I'd love you to check that out and share what you think of it. But anyway, where I'm going with why the CPI number doesn't matter, this is the best analogy I could come up with. I was thinking about this on the drive into the studio today. I've got a very good friend of mine who races professionally. He races motorcycles, and like the GP Moto guys, but he's not on that level. But the guy's amazing. You know, watching somebody do 130, 140 miles an hour on a motorcycle and live to tell about it's quite impressive. But that guy, when he's evaluating tire pressure and tread wear and turn angle and all of those technical, super technical, minute details, he's even looking at the humidity, the air temperature, and the track temperature when he's determining whether he had a good run or a bad run or the tire wear that's expected during a race. And when his bike comes off the track, they clean the tires and they put these heated blankets on him. And the first time I saw it, I thought he was nuts. But it's super important at that very high level of performance to know if you've got 18 laps or 20 laps out of a set of tires. Well, for you and I, the regular people in the world, when we're driving to work, we don't care what the temperature is. We don't care what the humidity is or the asphalt temperature. We drive our car to work and then we drive our car back. Yeah, maybe we got, 0.2 of a mile less on a 60,000 mile tire because of air pressure. But in the real world, those aren't the super important details. We're looking at how long does it take me to get to work? How much gas does it take me to get to work? Is my oil in my car at the right level? Is my car well maintained? And that's the stuff that we're talking about when we're buying real estate. What's my budget? Is that house that's $310,000 at the end of the street, does that house have all of my needs met? Does it have the third bedroom? Is it a 2-car garage so I have room for my motorcycles? Okay, great. That's the house. Check. Okay, do I qualify for the mortgage? Do I have enough down payment? Is my credit score adequate? Do I ratio, meaning will my income support the debt? Okay, boom, done. Check. Now, this is the most important number in the transaction. Is that monthly number, that expense, that principal, interest, taxes, and insurance, is that aligned with my budget? Am I paying that now? Is my rent $2,500 and my mortgage payment's going to be $2,500? Boom, done. That's the most important number because, guys, the easiest way to build long-term wealth is to start creating equity wealth for you and your family. And you do that by buying real estate. Because in 20 years, if you're still renting, you've got zero in equity. And guys, we've done the show before. We've gone all the way back to 1940 and shown decade over decade, there's not been a period in the last 80 years in this country where real estate's gone down decade over decade. Yes, there have been booms and busts in periods of correction. But long-term, real estate has always gone up in value. So if you're chasing the CPI number and you think that's a deciding factor, you're looking at the air temperature, the humidity, and the asphalt temperature when you're trying to determine whether it makes sense to drive your car to work. My point is, unless you're racing GP Moto, that stuff isn't what you look at every day. It's the other big important numbers like budget. So guys, thank you for bearing with me during that analogy, but don't get wrapped around the axle with details that just don't matter when it comes to a day-to-day expense. So guys, I hope that made sense, but you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we're going to cover more of the data and we're going to dive into your questions. We'll be right back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, if you've got questions, shoot them over to us, 855-462-7292. That's 855-462-7292. That's the Anytime Hotline. And Jen is standing by, womaning the hotline. She'll get your questions on the air. And I know we've already got a couple that have come in because she's given me the signal. And guys, it's not that signal. It's a thumbs up. It's not that finger. She's holding up a finger, but not that finger.
Let's get this party started.
Okay, I'm ready when you are. Throw me question number one.
Connie is asking, what is the minimum down payment for a first-time buyer? Can I use my tax refund as a down payment?
Hey, Connie, that's a great question. So let me start with the second question. Yes, you can use your tax refund. And as a matter of fact, I shared a story, I think it was last week, of a young married couple who during the pandemic had to move back in with her parents, and they have made the best of it, but they're ready to go out there on their own, and they're using their tax refund as their down payment. And both sets of parents are helping them with gift funds for their closing costs. So absolutely, source of down payment is fine if it's going to be the tax return. Absolutely. And it's a great use of a tax return. And then to answer your other question, there are first-time buyer programs with as little as 0% down, I'm excited to say. So if you don't qualify for one of the grant programs that enable you to borrow 100% of the purchase price, then figure somewhere between 3 and 5%. Most likely it's going to be 3 or 3.5. FHA is 3.5, and it's a great program for first-time buyers. Has a wonderfully beneficial interest rate compared to conventional. And the mortgage insurance component of FHA has recently been reduced. So it is a great option for first-time buyers. And there are many, many grant programs out there that will gift or loan that 3.5%. So it's a good place to start. But I appreciate that question. Hey, Jen, do you have another one?
Yvonne has this question. I've heard talk about permanent payment buy down and a 3-2-1 buy down. Can you explain the difference? They both lower the payment, right? Thanks.
They do both lower the payment. So the interest rate on the 3-2-1 buy down is 3 full % lower the first year, 2% lower the second, 1% the third, and then it goes back to where it started. So let's say, just for round numbers, the rate of the day was 6.5%. Year one, you would be making a payment based on 3.5%. Year 2, 4.5, year 3, 5.5, and then it would go to 6.5 and stay there for the rest of the loan. Now, the permanent rate buy down won't move that far down, but it never adjusts. So you might take a 6.5% loan and buy it down to 5.5 or 5.25, or maybe get lucky and grab a 5% rate. But the nice thing about the permanent rate buy down is it starts and stays in that instance at 5 or 5.25, whatever you buy it down to, and never adjusts again. I personally prefer that option because I'm a little more conservative and I don't like a payment that increases over time. I'm a big fan of that fixed payment for the life of the loan. So, but they both lower your payment and they're both a great option. Now, with the 3-2-1 buy down, you're going to qualify on the fully indexed rate, if you will. So you would have to be qualified at 6.5%, even though that first year your payment is based on 3.5%. With the permanent rate buy down, you're qualified at the lower rate because it never adjusts. So I hope that makes sense. That part gets a little bit confusing for people sometimes, but I would be happy to spend some more time with you if you need more info. But I appreciate that question. If anybody out there has questions regarding that and would like to go a little deeper, give us a call, 855-462-7292. As I mentioned, that rings here when we're in the studio on the air doing the show, but it also pushes to my office when we're not. So that's a great way to get us, or check out MrMortgageRadio.com. All our contact info is on that page as well. But hey, Jen, let's get another question in. Are you ready?
Larry has a question. We're selling our house in Boston this summer and moving to Florida. We both have jobs lined up. How soon after we move can we buy a house? Is there a waiting period because of new jobs?
Hey, this is a great question, and I want to take a second to explain it. So, Larry, thank you for that, my man. Wonderful question. So a lot of people get this one wrong because we're all conditioned to believe we need 12 or 24 months employment history before we can qualify, which is true, by the way. The part that gets people confused is we make the assumption that that has to be on the new job with the new company, right? So here's something that's pretty interesting. If you're staying in the same field and your job is similar to the job you have now, then you may not have to establish 12 months work history in the new location. Now, the best way I can explain it is to give you an example. We are working with a couple right now, young family, relocating from Pennsylvania to Northeast Florida. She's a school teacher and he's a sales executive. She's transferring from the school district in Pennsylvania to a school district in Florida. She's a teacher. We have a shortage of teachers all over the country. We know that's not going to be hard for her to get a job. As a matter of fact, her new position is already secured, which is the key element to this strategy, if you will. He's going to work for a competitor. He would have stayed with his current company, but they don't have a facility in Florida. So he's going to work for a competitor in the same role, being paid the same way, and a little bit more money on his side, a little bit less money on hers. I guess Florida teachers don't make as much. But here's the thing. They're moving from Pennsylvania into their Florida house. They're closing on the house before they even put 1 day's worth of work in on the new job. They've got their employment letters in place. The jobs are in the same industry. They've already established a successful work history in those industries, in those positions. So I share that because you might be able to make the transition the same way, where you just relocate directly to the Florida house and start the Florida job, the week after you close. So, but brilliant question. If anybody out there needs more info about that, give us a call, shoot us a text, shoot us an email. I'll be happy to spend some time with you and explain it in detail. But you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark-Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel. This is the Mr. Mortgage Show, and you heard the man. If you've got questions or comments, you can call or text 855-462-7292, 855-462-7292. That is the Anytime hotline, and Jen, my producer, is womanning the hotline. She'll get your questions on the air. And hey, guys, we call that the Anytime hotline because it rings here in the studio when we're on the air, but that also pushes to my office. So if we're not on the air and you need us, you can also use that number, 855-462-7292. And the easier thing to remember is MrMortgageRadio.com. MrMortgageRadio.com. All our contact info is there, but there's also an email icon on the bottom of that page. And if you've got questions or comments, you can shoot them to us via email by visiting mrmortgageradio.com and hitting that email icon, and Jen will get your questions on the air. But I am going to throw it over to her. We've had some good questions right out of the box, and let's see if we can't keep this going. What do we have, Jen?
Joe sent us this. How long does a rec refinance take? If we start the application next week, what's a realistic timeline?
Hey, Joe, that's a great question. So the rec refi takes no longer than any other mortgage transaction. So we're closing those in somewhere between 21 and 30 days pretty regularly. If it's a very obscure or a rural property that requires a little bit more time on the appraisal, that might push closer to 30 days. But a rec refi should take 30 days or less. And I hope that answers that question. And hey, guys, if you're curious, the rec refi, REC, stands for reduce, eliminate, or consolidate. And we're using that refinance loan program when you're paying off credit cards or paying off a car payment. You're consolidating some debt and you're reducing your overall monthly outflow. That is a great loan program designed exactly for that. I share a story all the time of a gentleman whose mortgage interest rate did indeed go up almost 2 full percentage points. But he paid off a couple truck payments, some credit cards, and his monthly expenses went down significantly. So that extra cash that he's saving every month in overall expenses, right? The mortgage payment went up, but everything else is gone. That's what he needed to get back on track. So yes, a lot of people are under the assumption that the only time it makes sense to do a refinance is if you're lowering your interest rate. But guys, people refinance for a lot of reasons. And you hear that spot that we run occasionally during the show. I mean, whether it's cashing out to put your kids into school and you need tuition money or unforeseen medical expenses, or a lot of people right now are pulling cash out of their home and using that equity to go buy rental properties because the rental market is so very strong right now. So brilliant question. I hope that helps. If you need more info, you can reach out to us. But I appreciate that one. Hey, Jen, what else do we have?
Stephanie is asking, my sister and I want to buy my aunt's condo. I think it's worth around $400,000, but she will sell it to us for $300,000. Can we finance the whole $300,000? Thanks.
Hey, Stephanie, that's a great question. My mind instantly goes to gift of equity in a situation like that. Use the gift of equity strategy. So to answer your question, yes. And the way that would work with a gift of equity is you could write the purchase contract at $400,000 and she could gift you $100,000, which would put your loan to value at 75%. And that would alleviate the need for mortgage insurance. She could gift you the full $100,000 and then you're financing the entire $300,000. She can gift you the closing costs also. So that would be a strategy that would allow you to get into the transaction with no money out of pocket. And if you need help with that, give me a call. I'd love to explain that to you in detail. But it sounds like you've got an amazing opportunity to, one, buy a property with instant equity and to finance the entire amount. So what an awesome opportunity. And guys, one more reason why somebody's decision long ago to buy a property is making all the difference in the world now, because Stephanie's aunt clearly has built up enough equity to make this work. So brilliant question. I hope that helps. If you need more information, we are here and I'm happy to jump on a call with you. But thanks for that, Stephanie. Hey, Jen, do you have another question?
Rhonda sent us this one. I want to buy a triplex and live in one apartment and rent the other 2. Can I count the rent from the other 2 apartments to help me get approved?
Wow. You guys are amazing this week. Another fantastic question. And kudos to you for looking at this amazing opportunity, because with a triplex or a duplex or a fourplex, so 2 to 4 units, you can utilize an FHA loan or a conventional loan with primary residence guidelines, meaning you could borrow 96.5% with FHA or 97% with conventional lending and buy an income producing property. Now, the caveat is exactly as you mentioned, you have to live in one of the units to qualify under those guidelines. But man, What a brilliant way to live for free or close to free, or in some instances, even make money. So way to go. And to answer your question, yes, the rental income from the other 2 units can be utilized as income when calculating your debt to income. And there's ratios and calculations that need to be applied, and I'm happy to spend more time with you. But to answer your question, yes, the rental income will help you qualify in a scenario like this. So well done. That's a brilliant opportunity and a brilliant strategy, and I'm very excited for you. Way to go. Hey, Jen, can we get another question in?
Sophie wants to know, I got an offer to buy my house. They want me to sign the deed to them and make monthly payments. The payments are much more than my current mortgage payment, but this seems fishy. Is this legal?
Oh boy. Okay, Sophie. First, I'm not an attorney, so I'm not going to say legal or not legal. I've heard people argue both sides of that one, but I'm going to tell you what I don't like about this from the seller's perspective. So you'll hear this called a sale subject to mortgage, or a wraparound mortgage, right? So you're keeping your current mortgage in place and the buyer's either paying it for you or they're paying you a larger amount that enables you to pocket the profit and make the mortgage payment, which is tempting. But here's the challenge. If you deed the property to them, they now own the asset, but you own all the debt. You're on the hook for the mortgage. So if you deed the property to them and they never make a payment, and that property goes into foreclosure, guess who's going into foreclosure? You. Guess whose credit is damaged? Yours. So I never, ever like the idea of giving up ownership of the asset and keeping ownership of the debt. And people will often do that with what's called a quit claim deed. So I don't like that. And then secondly, almost all, I'm guessing all at this point, residential mortgages have in them what's called a due on sales clause, which means once the ownership interest of the property changes hands, your mortgage could become payable, your current mortgage. So not a fan of this from the seller because you assume all of the risk. I'm not a big fan, even if they're giving you a big lump sum up front that's super attractive. So if you want some ideas about other workarounds, ways that they might be able to qualify, I'd be happy to help. But great question. Just not a fan of this as a seller. As a buyer, hey, it's a big win. So anyway, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. And Sophie, if you need to talk, give us a shout. But sit tight, guys. We'll be right back. Hey, it's mark-eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's mark-eitel, NMLS 1929005. Now, back to the commercials.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to mark-eitel and the Mr. Mortgage team.
Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is mark-eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel, and you are tuned into the Mr. Mortgage Show. Guys, we do this each week right here. Same bat time, same bat station. Guys, if you've got questions or comments, just give us a call. Shoot us a text. The Anytime hotline is 855-462-7292. That's 855-462-7292. Jen is standing by, womaning the hotline, and she'll get you on the air. If you prefer to shoot us an email, just check out mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot over your questions that way. And man, we've had some amazing questions so far today. A lot of good stuff has been covered. So let's keep the questions rolling. Jen, are you ready? Okay, what do you have?
Tammy sent us a text. We have a contract on our house, but the buyer appraisal came in low. Now we're stuck. We're all ready to put a deposit on a new house and need to sell this one first. It feels like they know we're stuck and they want to lower the price. Can we force them to get another appraisal?
Okay, that's a great question. Firstly, I'm sorry that you're in the pinch because you're the domino, right? We talk about this all the time. You're selling and buying. So you need two transactions. You need two dominoes to fall to make this work. And it gets super, super stressful. So I hate that you're in the middle of this. But to answer your question, no, you can't force them to get another appraisal. And they're not obligated to even request a reconsideration of value. And that's typically the protocol or the recourse, right? If you're buying a property and the appraisal comes in low, you and your agent and your lender on the buyer side can get together and review the appraisal, and you can submit material facts that were overlooked or mistakes that were made. And sometimes it's a super simple clerical error where the county might have your property listed as 1,800 square feet, but it might actually be 2,100 square feet. And it could be simple as a data entry error, or somebody forgot to update the floor plan when an addition was put on the house 30 years ago. So in that instance, you've got a legitimate request because you're being compared to other 1,800 square foot homes and you're actually superior to all the comps. So you're going to want, as the buyer, to go through that appraisal and look for data that was either incorrect or completely missed. A comp was missed. And you as the seller, you can request the buyer to give you a copy if you want to help with that, but they're not obligated to. And you're right, sometimes it's a big negotiating ploy. They really don't want the appraisal to come in higher because they want to negotiate a lower price. And you're not entitled as the seller to see that appraisal. It's the property of the buyer. But if everybody's on good terms, you may be able to work together to get a reconsideration of value. But to answer your question, you can't force them into doing it. And sadly, when the appraisal comes in lower, now everything is adjusted down because the loan amount is a percentage of the purchase price or the appraised value, whichever is less. So that happens also if you're buying a property for $400 and it appraises for $425, you're still only borrowing a percentage of $400. It's whatever's lower. So give me a call or shoot me an email and I'll run one of those value reports for you. And it's not an appraisal, but it's a very comprehensive value report in which there are comps, in which are property specifications, and you can see very clearly how the value stacks up against the appraised number. And in that report might be some data that your listing agent or the buyer's agent could use to assist with having them request a reconsideration of value. I'm happy to do that for you, and that might be a good jumping off point, because if the value report comes back wildly different than the appraisal, then there may be a likelihood that there is some data that was left out or overlooked in that appraisal. So anyway, I appreciate that question. And if there's any way we can help, I'm happy to do it. But that might be a great place to start. And I'm more than willing to run that report for you. So give me a shout and I'll shoot one over to you at no charge. Hey, Jen, do you have another question?
Zach sent us this question. I'm recently divorced. She kept the house, but the mortgage is still in both our names. How much of a hassle will this be when I try to buy a new house? Thanks for your answer.
Hey, Zach, this is another place that people always get wrapped around the axle. And as long as she's making the mortgage payment, then you're okay. But here's the challenge. What happens if, and we see it happen all the time, people make decisions based on emotion and not logic. And I've seen the ex-wife do this, and I've seen the ex-husband do this. One is responsible for paying the debt. They get mad at the other person, gets upset, and he stops paying for the mortgage payment. In the divorce decree, he had to pay the mortgage payment. Well, guess what? Now both of their credit is affected. So I know that's not what you asked, and that's not the scenario, but the reason I'm sharing that is because you're responsible for the debt, but she owns the house. And a lot of times and I don't know what it is with divorce attorneys. I see it a lot. They'll use a quitclaim deed to take the husband off the title, right? So now it's just in the wife's name. And we had a question like that earlier in the show where someone was going to sell the house and deed the property over to the buyer, but they were going to keep their mortgage. It's the same scenario. What happens if she stops paying the mortgage? If she gets mad at you because you're dating the 35-year-old aerobics instructor, and she's just, I'm not making the payments anymore. I'm going to hurt him. And she hurts your credit. So I never like somebody to own the debt and not own the asset. But that's a whole nother conversation. The right move, no matter who ends up with the asset, is to refinance the house into that person's name solely. And if they're unable to qualify, then the right move is to sell the house, let them take that equity and start over somewhere else. But regardless of how it happened, as long as she's making the mortgage payment, and you can show that, credit will indicate that, but you're going to have to maintain a relationship with her, because at any given notice, when you try to buy another property, you need to confirm that she's making that payment. Because here's the other side of it. In addition to credit, if that debt's on your credit report, it's going to count against you. So if that mortgage payment is $2,500 a month, guess what? That $2,500 a month is on your debt calculation until that's out of your name. So even if she is paying it, that's still counting against you unless you can get her to help you confirm she's made the last 12 payments. And it's typically canceled checks or bank statements showing that she's making the payment. And then in that instance, they won't count the debt against you when you go to buy the new property. But for a whole host of reasons, this is not an ideal scenario, but we see it all the time. So if you're on good terms and she's willing to document that for you, that's awesome. But I've seen that happen too, where she is just mad, nasty mad, and she's not going to help. So I don't know, man. I've never liked that scenario. We see it happen all the time. We see it with boyfriend, girlfriend. We see it with brother, sister. They'll buy a property together. I'm in the middle of a scenario right now in Western Fort Pierce with two sisters, and these are grown women past middle age that bought a house together. And after a year, they can't stand living with each other. They both got divorced, and they both wanted to start life over. And they thought, sister, let's do it. They're family. This is going to work. Well, guess what, guys? One is living a very active life, and the other wants to be in bed at 8 o'clock. And their lifestyles are incompatible. So now they're trying to figure out, what do we do? I can't refinance it solely into my name. She can't refinance it solely into her name. Do I let her quit claim me off the property, move a boyfriend? It's a complicated mess. So if you're going to own the debt, you need to own the asset. That's the easiest way I can say it. So anyway, brilliant question. I'll be happy to deep dive that with you if you need more info. Clearly, I have strong opinions about it only because I've seen it backfire on a lot of people. But anyway, I appreciate that one. Call us if you need more info. Oh boy. But anyway, guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, you're in the right place if you want the answers to your questions, the data, the tips, the tricks, the inside information that you need so you can make better real estate and mortgage decisions for you and your family. If you've got questions or comments, get them on the air by calling or texting 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And when we're not in the studio doing the show, that number rings to my office. So you can get us anytime on that number, 855-462-7292, or check out MrMortgageRadio.com, MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can send over your questions via email. So, man, we've had some amazing questions so far. You guys are bringing it this week. A lot of really, really good questions, and I certainly do appreciate that. But speaking of your questions and speaking of Jen, let's keep this rolling and throw it over to Jen for another question. Hey, Jen, what do you have?
This one is from Shane. Okay. Is there any way around the new credit score penalty fee? I know enough to know not to tank my credit to get a better deal, but will they overturn it soon?
Hey, Shane, that's a brilliant question, my man. I don't think so. I've never, ever seen the government undo anything as far as taxes or expenses, or it always seems to be the spiel. You know, I remember when I was a kid hearing my grandfather talk about the Florida Turnpike was going to charge tolls until the road was paid for. Well, guys, I'm an old man, and there's still tolls on the Turnpike, and I'm pretty sure that it's been paid for a few times by now. So to answer your question, I don't think it's going to be rescinded. I know a lot of people are up in arms about it. There are some workarounds. So there's some creative strategies around it. I would need to know your specific scenario to see if any of it applied to you. But I would just, as frustrating as it is, I think they're here to stay for now, and just be as creative as you can to work around it. And we've got some strategies in place I would be happy to share with you. But I appreciate the question. If you want to talk a specific scenario through with me, just give me a call or shoot me an email. And I'll spend some time with you and we'll figure out a workaround. We're doing it every day for our clients, and it's proving successful. So we're pretty happy with coming up with strategies around it for the time being. But anyway, I'm going to throw it over to Jen. Hey, you got another one?
Nora sent an email. I thought I could only refinance to lower my mortgage rate. But if I heard you correctly, that's not true?
Hey, Nora, thank you for paying attention. I wonder sometimes if I'm the only one listening to the show, but you're right. A lot of people think you can only refinance if you're lowering your rate, therefore lowering your payment. And we talked about a scenario earlier in the show where a gentleman is using the rec refinance to pay off a bunch of debt. And yeah, his mortgage payment's going to go up, but his overall monthly expenses are coming down a lot. And because of that, it makes sense for him, even though he's increasing his rate. And Nora, that's your equity. As long as you qualify for the payment, you can pull it out for any reason. You can take it out to go to Vegas if you wanted. I mean, I wouldn't advise it, but you could. A lot of people will pull equity out to use as a down payment on an investment property, or as we mentioned, to pay off debt or some medical expenses, or if they've got college-age students and they want to use it for tuition, you can use that equity. That's your money. You can access it and use it for whatever you want. So increasing the interest rate does not prohibit you from refinancing. Now, you definitely want to look at all of the options and make sure it's a fiscally responsible decision, because, it's not just a one and done. You're making that payment for a long time, but it's your money, and people access their equity all the time to make some strategic moves in life. So brilliant question. And thank you for catching that, because I do find a lot of people make the assumption that refinancing is only permissible, not even advisable, but permissible if you lower your interest rate, and that's not the case. So great question. Thank you for that, Nora. Hey, Jen, do we have another one?
Brianna's asking, how hard is it to assume an existing loan? I found a house with an FHA mortgage at 3.125%, and the seller says I can assume it. How do I get started? Neither of us have a real estate agent.
Hey, Brianna, that's a great question. And now's a great time to do this. So to assume a loan, you contact the servicer, and the servicer is the company that the seller is making their mortgage payment to right now. So you don't start with a bank. You don't even start with someone like me. You start with the servicer, because they have to approve you under the terms of the current loan, because they're going to essentially transfer that loan into your name. So the jumping off point and this applies to any assumption, guys, it's the servicer, not a brand new lender, not even the original lender, because oftentimes that loan was sold, sometimes many times since it was originally originated. So call the servicer. So whoever the seller is making their mortgage payment to, there's a number right on that statement. There's a number when they log in. You, as the new buyer, if you will, call that servicer to start the process. Now, one thing to keep in mind, it's not a fast process. If a new loan takes, 21 to 30 days, this is going to take longer, sometimes 6 weeks, 8 weeks sometimes an assumption can take, because the servicers aren't originators. They're not built to originate new loans. It's just they don't have the workflow smooth. It doesn't happen often enough that they have a full-fledged assumption origination department. So just know the process is a little clunky, but it's a brilliant, brilliant time to take advantage of assuming, in this case, an interest rate in the very, very low threes, which is amazing. But another thing to keep in mind, guys, you're assuming that loan exactly as it exists, meaning the remaining balance and the remaining term. So let's say you're buying a house for $500,000 and there's a loan on it for $300,000. That's what you're assuming. You've got to come up with the $200,000 to bridge the gap. And that's where a lot of assumptions fall short, is people are unaware. They think they're just assuming that rate and they're starting over. That's not the case. If there's 23 years left, if there's 17 years left in the mortgage, that's your term, and the principal amount is assumed exactly as it exists today. And again, that's where a lot of people get wrapped around the axle, because to use that example that I just did of a $500,000 house with a $300,000 mortgage, you would have to qualify for the assumption and come up with the $200,000 to bridge that gap. So just know that going in, you're going to want to ask the seller what the mortgage balance is, the principal balance, and then do the math to make sure that you can come up with the down payment to make up that difference before you even start that process, because you'd hate to get, 3/4 of the way into it and realize that you're not going to be able to bridge that gap. And guys, a non-veteran can assume a VA loan. Yep, you heard that correctly. That's another one people get wrapped around the axle. A non-veteran can assume a VA loan. Now, here's the thing. It's not advantageous for the veteran, the selling veteran in that case, because their eligibility is going to be tied up with the assumption of that loan, but it is doable. But yeah, great opportunity to assume a mortgage right now. Just know all of that info going in. And we're here and we're happy to help if you need more info. Well, oh, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Where does the time go? Guys, I have so much fun doing this with you. Hey, if you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Hey, do me a favor, share the show, spread the word. We're a national brokerage. If you can hear my voice, we could be your choice for a mortgage. So give us a shout. We're here and happy to help. Otherwise, have an amazing week. We'll see you next time right here on the Mr. Mortgage Show.
That's a wrap. Join mark-eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on the Mr. Mortgage Show.